Let's say there are two bonds, bond B1 and bond B2. Bond B1 has an annual coupon of 10%, bond B2 has an annual coupon of 15%. Periodicity for B1 is semi-annual, periodicity for B2 is quarterly, that is m is equal to 2 and m is equal to 4. The current price for B2 is 104. The current price for B1 is 96. Maturity for both the bonds is 3 years. Yield to maturity for B1 is 11.6171 and for B2 is 13.3598. Current yields for B1 is 10.4167, for B2 it is 14.423. Now we have to find out which bond is riskier and what is the compensation it is giving for the risk. Now, from this we cannot compare the riskiness. First, to measure the riskiness, the periodicity has to be same. So, either both these bonds have to be converted into semi-annuals, or both these bonds have to be converted into quarterly periodicity. First, let us convert this quarterly bond into semi-annual periodicity. Let's see what transpires. So, we already know 1 plus y2 by 2 whole square is equal to 1 plus y4 by 4 whole to the power 4. We already know y4 here, right? That is the yield which is compounded quarterly. We already know that. This is the yield. So, this implies 1 plus y2 by 2 square. This is for B2. We are converting it to m is equal to 2. 1 plus 0.133598 by 4 whole to the power 4. This is equal to, let's calculate. This comes to 1.14044. Therefore, y2 by 2 comes to be root over of this minus 1, right? 1.14044 root minus 1. This is equal to 0.06791. Therefore, y2, this is for B2, comes to be 0.67914 into 2. This is equal to 0.1358. Okay. So, this is the y2 for B2, bond B2. The spread between y2 for B1 and y2 for B2 is 0.1358 minus 0.11617. This is equal to 0.01966 approximately, which means 1.966% or 197 BPS approximately, 197 basis points, right? Now we convert B1 to a quarterly basis and see what is the basis difference. So, basis difference, why are we taking it out? We are just trying to find out the compensation B2 is paying to make up for its higher risk. This is compensation B2 is paying to make up for its higher risk. Now we turn both of them into the quarterly basis. Already B2 is in quarterly basis, so we do not have to do anything about it. We just have to turn B1 to quarterly basis. Let us do that. So for B1, we are converting it from m is equal to 2 to m is equal to 4. 1 plus y 4 by 4 whole to the power 4 is equal to 1 plus y 2 by 2 whole to the power 2. This is equal to 1 plus y 4 by 4 whole to the power 4 is equal to 1 point, we just have to divide it by 2, the percentage terms of it. So 0.116171 divided by 2 plus 1 whole square. This is equal to 1.1195 approximately. So this comes to be 1 plus y 4 by 4 is equal to 1.0286, implying y4 is equal to 0.1145 or 11.45%. Now in this case, the spread between B2 and B1 comes to be y4 for B2 minus y4 for B1. This is equal to 13.3598 minus 11.45. 1.9067% or 191 BPS. So in quarterly terms, this is the payment that is being made by B2 to compensate for the higher risk. Yield to worst for a callable bond. What do we mean by this? Let's see. Let's say we have a callable bond with 5 years of maturity. 0, 1, 2, 3, 4, 5. Okay. Now, the bond is callable at years 3, 4 and 5. Callable means the issuer can call back the bond or buy back the bond at a given price. Let's say the initial issuance was at 100 and the coupon was 6%. Right? And the callable price is also 100. So whenever the issuer decides to call back, the price he has to pay is 100. So if the bond is called at t is equal to 3, then what is the yield? Y3 is given by, now let's say the current price of the bond is 102. This is equal to 6 by 1 plus y3, y3 being the yield if the bond is called at t is equal to 3, 6 by 1 plus y3 square plus the callable price is 100. So this becomes 106 by 1 plus y3 whole cube. Right? So from this we can find out what y3 is. We just have to plug in these values in the calc, or we can also do it manually here, but it's better to do it this way. PV is equal to 102, let's say it is negative. FV is equal to 100. Periodic payment is 6. Number of periods is 3. We need to find out the yield. Let's do that. Yield is coming to be 5.2619. Okay. So this is our yield if the bond is called at t is equal to 3, right? What if the bond is called at t is equal to 4? In this case 102 is equal to 6 by 1 plus y4 plus 6 by 1 plus y4 whole square, 106 by 1 plus y4 to the power 4. Here also we can find out the value easily. This comes out to be y4 is equal to 5.4303%. So if the bond is called at t is equal to 4, the yield is 5.4303. Similarly, we can easily find out y5, which will come to be 5.5312. Now here the lowest yield is y3 and the highest yield is y5, 5.5312. The lowest yield here is called the yield to worst. This means that the yield to the investor will be lowest if the bond is called at t is equal to 3. Valuation of a floating rate note. Now we know that in case of a floating rate note, the coupon is not fixed, right? Coupon is variable. Usually it is some market reference rate, which can be some interbanking rate, which can be some interbank lending rate plus some other percentage, right? Let's say it is 2%. We are going to take an example and understand how to value it. Okay. So now the coupon, let's say, is MRR, some market reference rate, plus 2%. Let's say the maturity is 5 years. Let's say it's a quarterly coupon paying bond. Okay. So the periodicity is 4. Now in case of a floating rate note, there is no fixed yield also. The yield, this is also subject to the reference rate plus some percentage, let's say 3%. Okay. In this case, the yield is committed to be MRR plus 3%. This coupon and this yield are annualized figures. Annualized figures. Also, let us assume that the par value or the future value is 100, right? Now from this we will like to explore what is the expression for a floating rate note. So here let's first find out what are the periodic payments. So the periods will be, first of all, because the periodicity is 4, the periodicity will be 0, 0.25, 0.5, 0.75, 1, ... If the maturity is 5 and the periodicity is 4, then n is equal to 5 into 4, which is equal to 20. So there will be 20 periods like this, 19.75, 20. Yes. Now let us understand what are the periodic payments. So before we understand the periodic payment, we have to assume our market reference rate at each of these periods, right? So let's say the market reference rate at 0.25, t is equal to 0.25 is 2%. At 0.5 it is 1.75%. At 0.75 it is 1.5%. Then at 1 it is again 2%, like this, right? At 19.75, let's say it is 1.75%. and at 20 it is again 2%. Okay. Therefore, now we are in a position to calculate first the coupon percent. Let us calculate coupon percent. Coupon percent at this period will be 4%, but it will not be 4%, guys. Think once again. These MRRs that we get are annualized rates, right? These are annualized rates, and this coupon rate that we have got is also an annualized coupon rate. So we have to divide it by the periodicity to get the number. So this will be 1%. This will be 3.75 by 4, because 1.75 plus 2% divided by the periodicity. This will be 3.5 by 4. This will be 4 by 4. This will be 3.75 by 4. This will be 4 by 4. And these are all percentage figures, right? Coupon percentages. From this one, we can decide on the periodic payments, right? So periodic payment will be this coupon percent multiplied by the future value. So future value is 100, right? This will be 0.01 into 100, right? This will be the first periodic payment. The second one will be 3.75 divided by 4. How much is it, guys? Let us calculate. 3.75 divided by 4 divided by 100. This is 0.009375. So this will be 0.009375 into 100. This will be the second period. Like this, the payments will go on till again it will be in this period, at period 19.75. This will be again 0.009375 into 100, right? And the last period, this will be the last periodic coupon plus the future value. So this will be 0.01 plus 1 into the future value, which is 100, right? Now, to calculate the present value, we also need to know what is the discount rate, right? So the discount rate here, we have mentioned it is the yield, which is MRR plus 3%, but again this is annualized rate. So we have to divide this MRR plus 3% by 4. So let us calculate the discount rates. So the discount rates, that is the yield at each period, at 0.25, it will be 2% plus 3%, right? So it is 5 by 4. This is a percentage number, okay? This is 4.75 by 4, 4.5 by 4, right? This way it will go. Again the last period, or the 19th period, 19.75th period, that is, this will be 4.75 by 4, and the 20th period it will be 5 by 4 again. So these are the discount rates, right? Now we are in a position to calculate or to find the expression for the present value, guys. Present value. Present value, say for the first one, for this one is 0.01 into 100 by 1 plus 1.25 by 100. Why 1.25 by 100? Because this is 1.25 and it is a percentage figure, so we divide it by 100 to get the discount value, right? And because the period number is 1, so we write to the power 1 here. The second period, we can write the periodic payment 0.009375 into 100 by 1 plus 4.75 by 4.75 by 4, the second value we will be taking. So this is 1.1875 by 100. Now because this is the second period, we write to the power 2. Like this, there will be 20 periods, and the final payment will be, guys, this will be 1.01 into 100 by, last period again is 1 plus 1.25 by 100 to the power 20, because this is the 20th period, right? Now we rewrite this expression. This will be 1 by 1.0125 to the power 1 plus 0.9375 by 1.018 to the power 2 plus dot dot dot, again the last expression, this is again 101 by 1.0125 to the power 20, right guys? So we are just looking to find out the expression, so we can re-engineer, that is, we can do some backward engineering and find out what is the expression, guys. So before we find out the expression, we have to understand two terminologies. This 2% here, which is the market reference rate plus the added percentage to get the coupon, this is called the quoted margin. Quoted margin or QM. And the yield percentage, MRR plus this 3%, this is called the discount margin. Or the DM. Now, what we did here, friends, is something like this. PV is equal to index or the MRR plus quoted margin divided by, let's say the periodicity is M, right? Instead of 4, it can be anything. It can be quarterly, monthly. So we write M for the periodicity into FV by 1 plus index, again the MRR, plus the discount margin by periodicity, right, to the power 1. This is the first expression. This is what we have done actually. Now for the second one, again index plus QM, QM and DM, QM and discount margin here do not vary. The index keeps on varying, that's why the entire value is varying, right? So index plus QM by M into FV by 1 plus index plus TM by M to the power 2 for this period number 2. This goes on till the last period is FV, future value, plus index plus QM by the periodicity into FV divided by 1 plus the index plus discount margin by M to the power the last period, that is, we write it capital M. Here this capital M, N is basically the maturity into the periodicity. N is maturity in number of years multiplied by the periodicity. So this is our final expression, guys. This is how we calculate a floating rate note. Now here we took the example to just understand what the these QM, DM, index, FV, all these things stand for. Now we will take an example to calculate the actual value of a floating rate note. So let's do that. Let's say there is a bond which is semi-annual coupon paying. So the periodicity is 2 and the maturity in number of years is 3. 3 years is the maturity time. At maturity, the FV, that is the future value, is paid at par and the bond is issued at par also. The quoted margin is 1% and the discount margin is 2%. We need to find out the present value. So this is the starting point, t is equal to 0. This is 6 months, 1 year, 1.5 years, 2 years, 2.5 years and 3 years. This is the maturity period. Okay. So the MRRs for these periods are 2%, 1.5%, 2%, 1%, 1.5% and 2.5%, let's say. So the periodic payment becomes 2 plus 1 by 2 for this one, 1.5 plus 1 by 2, 2 plus 1 by 2, 1 plus 1 by 2, 1.5 plus 1 by 2, 2.5 plus 1 by 2. Let's write the values. This is equal to 1.5, this is 1.25, this is 1.5, this is 1, this is 1.25, this is 1.75, right? These are the periodic payments. And the yield comes to, discount margin is 2%. So it will be MRR plus 2% by the periodicity. So this is 2 plus 2 by 2. This is going to be 1.5 plus 2 by 2. This is going to be again 2 plus 2 by 2. 1 plus 2 by 2. 1.5 plus 2 by 2. 2.5 plus 2 by 2. These rates can be written as, this is equal to 2, this is equal to 1.75, this is again equal to 2, this is 1.5, 1.75, 2.25. Now here we have found out actually the PMT percentages, right? So the present value comes to be 1.5% into FV, which is 100, by 1.02 to the power 1 plus, this is the quoted margin plus the MRR and divided by the periodicity. So this is 1.25% into 100 by 1.0175 to the power 2 plus, I do not need to write this in percentage terms. I can simply multiply mentally and say this is going to be 1.5, because 1.5% of 100 is 1.5. So this is 1.5 by this one. So this is going to be 1.02 cube plus 1 by this 1.015 whole to the power 4, then this one 1.25 by this one 1.0175 whole to the power 5 plus 101.75, because this plus 100 is going to be there, right, because of the maturity payment. This is 1.0225 whole to the power 6. See, there are 6 periods, 3 years of maturity and periodicity of 2. So we are on track. Now we just need to calculate the values. 1.5 divided by 1.02. 1.5 divided by 1.02. This comes to be 1.47. 1.4706, let's say. 1.25 divided by 1.0175 square. This is equal to 1.2073 plus 1.5 divided by 1.02 whole cube. This is 1.4135 approximately. This one will be actually 2074, because it is 20737. So if we approximate it, it becomes 2074. 1 divided by 1.015 whole to the power 4. This is 0.9422 plus we go to this one 1.0175 to the power 5 inverse into 1.25. This is equal to 1.1461 plus the last value 1.0225 to the power 6 divides 101.75. This comes to be 89.0337. So we add this all up, plus 1.1461 plus 0.9422 plus 1.4135 plus 1.2074 plus 1.4706. This comes to be 95.2135. This is our present value for this floating rate note. Valuation of money market instruments. Friends, money market instruments means those who have a maturity of 1 year or less, right? The 1 year convention, that is the 1 year duration, may be considered as 360 days or it can be considered as 365 days. And the maturity can be various. It can be 90 days, 91 days, 180 days, like that. It can be 360 days. Okay. Now, apart from this maturity period of the money market instrument, there are certain other metrics that have to be measured. Let's look at them. Now, how do we calculate the future value of a money market instrument? The future value of a money market instrument is its present value multiplied by 1 plus the ratio of its duration divided by the number of days assumed for the year. This ratio multiplied by something called the add-on rate. This gives us the future value. This is called the add-on rate. Similarly, when we try to calculate the present value, Then the expression is given by future value multiplied by 1 minus ratio of the duration of the instrument divided by the number of years, the number of days in the year, multiplied by something called the discount rate. This is called the discount rate. Now the year, again I'll repeat, can be of two conventions generally. One is 360 days, one is 365 days. Now when we calculate the add-on rate, assuming that the year has 365 days, then it is called a bond equivalent yield. That is the AOR, assuming year is having 365 days, is called the bond equivalent yield. Bond equivalent yield. The add-on rate, which is calculated assuming the year has 365 days, is called the bond equivalent yield. Now let us take a few examples to understand how they are applied. Let's say a money market instrument matures in 91 days. The year convention is 360 days. Okay. The future value is 100. The present value is 97. We need to calculate the discount rate and the add-on rate. Let's do that. We start with finding out the discount rate. Now from the expression we know that PV is equal to FV on which the discount rate works upon. How does it work? It works like this: PV is equal to FV multiplied by 1 minus the ratio of day and the total number of days in the year multiplied by the discount rate. Now we have seen that this money market instrument is 91 days. The year convention we have taken is 360 days. The FV we have already seen, the PV we have already seen. So all the values we have, just the DR we have to take out. So this implies 97 is equal to 100, 1 minus 91 by 360 into dr. So guys, we can easily rearrange the equation a little bit to get to this equation. So guys, we can easily rearrange this equation to get to this stage, right? So this means 0.03. Now we have the dr. dr is equal to 0.03 divided by 0.252778. This is equal to, we can easily calculate, 0.118681 or approximately 11.86%. 11.86%. 11.86%. Now if you wish to memorize an expression for discount rate, it is just a derivation of what we have learned in terms of PV and FV of the money market instrument. So PV is equal to FV into 1 minus d by y into dr. This equation itself can be rearranged to get to somewhere like this. This equation itself can be rearranged to get an expression for discount rate. How do we do that? So here we divide both sides by FV. This becomes 1 minus d by y into dr is equal to PV by FV. We take the d by y into dr expression on one side and the rest on the other side. So this becomes d by y into dr is equal to 1 minus PV by FV. This expression can be written as FV minus PV by FV. Therefore, dr becomes y by d into FV minus PV by FV. Now we are going to find the add-on rate. So we know that PV is equal to FV multiplied by 1 plus d by y into AOR, right? So from here we again have all the information except the AOR, which we can deduce from the other values. So let's do that. So we know that FV is equal to PV multiplied by 1 plus d by y into AOR, right? Now we have all the other information except the AOR, which we can find out by putting up the values. So here 100 is equal to 97. 97 multiplied by 1 plus 91 by 360 into AOR. This will be 1 plus 91 by 360 into AOR is equal to 100 by 97. This implies 0.252778 multiplied by AOR is equal to 3 by 97, 0.122352, or approximately 12.23%. Now from this we can easily derive an expression for AOR also, if you want to remember that or use that directly. This is equal to y by d multiplied by FV minus PV by PV. So this is equal to, add-on rate is equal to y by d multiplied by FV minus PV divided by PV. In case of discount rate, the denominator here was FV, here it is PV, just that is the difference. Now in the same problem, if the question is find the bond equivalent yield, let's say here the question is find the bond equivalent yield. How do you do that? Simply you find the add-on rate with a 365-day convention. Add-on rate we have known, y by d into FV minus PV by PV. Here instead of 360 we use 365. So this is 365 by 91 multiplied by 100 minus 97 divided by 97. Let's calculate it. This is equal to 12.4051%. So this is the bond equivalent yield. This is nothing but, as we have said earlier, AOR with 365-day convention. The reasons for yield differences between bonds. Now other things remaining identical, any of the factors mentioned in this page can lead to differences in yields. For example, currency. Let's say there are two bonds, one with a currency as rupees, another with a currency as INR. Just the difference in currency can result in differences in the yields of the bond because of exchange rate differences, because of that is expected inflation rate differences. Because of all these factors, there can be difference in the yields of two otherwise identical bonds but varying in currency. Let's say there are two otherwise identical bonds. One is having a credit rating of very high AAA status, and there is another bond which is having everything identical: currency, liquidity, tax status, periodicity, time to maturity, everything is same, but the credit rating is B. Here there will be a disparity in the yield. The bond usually with the higher credit rating will have lower yield. Yield is generally inversely related to credit rating. Other factors remaining same. Liquidity. Let's say there is a government on the run bond, right? That is the most recent released bond and a government bond. This bond will have very high liquidity. On the other hand, some high yield, high risk bond will have much lower liquidity. Taxation can vary depending on the issuer of the bond, right? A government bond may be taxed in one way, a corporate bond may be taxed in another way. Even corporate bonds which are varying in terms of industries can be taxed in different ways. So that is also a reason for the differences in yields of different bonds only in terms of tax status, even if other factors remain identical. Periodicity. Let's say a bond is a quarterly coupon paying bond and another bond is a semi-annual coupon paying bond. Even if all the other factors are identical for these two bonds, the yield will vary just because of these two factors. Just because of periodicity differences, the yield can vary. Let's say a bond has 3 years to maturity and another bond has 5 years to maturity. Now, even if the periodicity, tax status, liquidity, credit risk, currency, every other factor is identical, just because of this one factor, that one bond is maturing in 3 years and the other bond is maturing in 5 years, there will be differences in yield. Now, the yield to maturity versus the time to maturity curve is a matter of study. So this is called a yield to maturity curve. Let's say the time to maturity is plotted on the horizontal axis and the yield to maturity is plotted on the vertical axis, right? This can be 1 year, 5 year, 10 years, 20 years, 30 years, like that. And the curve can look like something like this. So as the time to maturity increases, in this case, the yield to maturity is also increasing. And at the end, in the longer terms, it may flatten out in the example that we have taken. This is also called the term structure or the maturity structure. Spot curve, par curve and forward rates. We will have an introduction of these terminologies in level 1. In level 2 material, there is much more detailed discussion of all these factors. So do watch out for it. The link of the video is provided in the description. A spot curve is basically the yield to maturity of zero coupon bonds of all sorts of maturities from 1 year till 30 years plotted in one single graph. So let's say this is the yield to maturity of zero coupon bonds and this is the time to maturity of all these zero coupon bonds: 1 year, 5 year, 10 year, 20 year, 30 year. Now let's say for the 1 year the yield to maturity is here, for the 5 year it is here, for the 10 year it is here, for the 20 year it is here, for the 30 year it is here. So the curve goes like this. So YTM of zero coupon bonds across all maturities. This can be generally government bonds. This is called the spot curve. Other terms used for the spot curve are strip curve and the zero. Par curve. Par curve means we are trying to find the yield to maturity of coupon paying bonds, which results in them trading at par value, that is 100% of par. Let's say for a 1-year coupon paying bond, the coupon is 5%. For a 2-year coupon paying bond, the coupon is 6%. For a 3-year coupon paying bond, the coupon is 7%. Now we need to find out the par curve from this. Let's do that, friends. So par curve is basically the yield which results in the bond trading at par. So we use this definition to find out the par values, par yield values. To find out the yield values which results in the bonds trading at par. So for the 1-year bond, this comes to be n is equal to 1, coupon is 5, present value has to be par, and future value is also at par. Therefore, the yield comes to be, it should be 5%, right? Yeah, it's 5%. So this is the year 1 par rate. For year 2, what we do is 100 is equal to 6 by 1.05 plus 106 by 1 plus par rate at year 2 whole square. This implies 100 minus 6 divided by 1.05. This is equal to 106 by 1 plus y2 square is equal to 94.2857, implying 1 plus y2 square is equal to 94.2857 divided by 106. This is equal to, so this is equal to 1.1242, y2 is equal to 6.03. So y1 is 5%, y2 is 6.03%. We need to find out y3, which we take out from this one. 100 is equal to, the coupon is 7, so we write 1.05 in the first year. Second year also we know 1.0603 square plus the final year we get 107 divided by 1 plus y3 cube. So from this we can easily deduce what is y3, right? So we can easily deduce this equation to this stage by calculating individual values. Now we do a cube root of this 1.228376. This comes to be 1.07097. Y3 comes to be 7.097%. Now we are ready to plot this par curve. Year 1, year 2, year 3. This is, let's say 1, 2, 3, 4, 5, 6, 7, 8. So the first year the value is 5. So 1, 2, 3, 4, 5. The second year the value is 6.03, so it is just above 6. The third year it is 7.097. 0.9, so just above 7. The third year it is just above 7. So the par curve will look like this. So the par curve will look like this somewhat. Let's say we want to enter a 5-year bond 1 year from now. Now obviously the spot rates won't work here because it is a future rate. So therefore we need some other kind of rate to calculate whether we want to enter that or not. The rate that we will look for in this case is the forward rate, and there are ways to calculate the forward rates. Let's see how. Let's say a 1-year bond has a yield to maturity of 4%. A 6-year bond has a yield to maturity of 7%. Now from these two information, we can find out the forward rate of a 5-year bond 1 year from now. How do we do that? Simply, let us call this rate Y1 and this rate Y6, that is the yield of a 6-year bond or yield of a 1-year bond, and the forward rate of a 5-year bond 1 year from now, let us call it F1Y 5Y. This is, by the way, a convention of expression also. Let's say we want to get into a bond of 2 years from now, we will write it 2Y 2Y. We want to get into a bond of 10 or 3 years 2 years from now, we will call it 2Y 3Y. This basically denotes the tenor. This is time from now at which we want to enter. This is, the first one is time of entry, the second one is the tenor for which we want to enter, right? So here we want to enter a 5-year bond 1 year from now, so it is F1Y 5Y. Now these three, 1, 2, 3 can be put together in an equation. This is how: 1 plus Y1 to the power 1 multiplied by 1 plus F1Y 5Y to the power 5 should be equal to 1 plus Y6 to the power 6. Now we know what is Y1, we know what is Y6, therefore it is easy to find out F1Y 5Y. We just do that. So this comes to be, Y1 is 4%, right? 1.04 to the power 1, which is 1.04, 1 plus F1Y 5Y to the power 5, this is equal to 1.07 to the power 6. This implies 1 plus F1Y 5Y to the power 5 is equal to 1.4430. So from here we can easily deduce what is F1Y 5Y. 7.6103%. Similarly, let's say a 2-year bond has a yield to maturity of 5%. A 3-year bond has a yield to maturity of 7%. From this, can we find out F2Y1Y? We can find, right? What is F2Y1Y? It is basically the forward rate of a bond of tenor 1 year which we want to enter after 2 years. So this becomes, if we call this Y2 and we call this Y3, 1 plus Y2 square into 1 plus F2Y1Y is equal to 1 plus Y3 whole cube. From here we can easily put in the values and find out the value, right? So F2Y1Y comes to be 11.115%. Like this we can go on calculating forward rates for different tenors and for different entry points if we know the correct values to enter. This F1y 5y, this F2y 2y, F2y 3y, these are all called implied forward rates. Benchmark and spread of a bond. Let's say a 5-year bond, a corporate bond, has a yield of 10%. Now this 10% can be bifurcated into various segments. These bifurcations, let's say the country in which this bond has been issued, the GDP of that country is 4%. This is the real GDP. So we add 4% in the rate. Then there is inflation of 3%. So we add the 3%. Now there comes credit risk. The individual business must be riskier than the country itself, the sovereign government itself. So that credit risk we add 1% because of that. Now this corporate is a profitable business, so it is taxed in some way. Compared to a government bond, the taxation on this might be higher. So we add 1% because of the tax reasons. Now let's say the government bonds which are on the run are the most popular and the most liquid bonds. So this corporate bond must be less liquid than that government bond. So because of that less liquidity, we add 1% more to it, right? So these are basically risk premiums. And these two basically form the risk-free rate. Generally, a government bond will have this kind of a rate if we are to assume these numbers, right? Government bond of same tenor, that is the 5-year tenor. Now, generally what happens is this government bond is looked at as the benchmark. That is basis which corporate bonds will be compared, and whatever higher yield the corporate bond provides is called the spread over the benchmark, right? Now benchmark can not only be the government bond, it can be a swap rate also. So when the benchmark is a government bond, the spread is called G spread. Now when the benchmark is a standard swap rate, we call the spread I spread. Now there is another spread called Z spread. Let us look at what that is. Let's say this bond, we want to discount this bond with spot rates, right? So let's say the current market price of this bond is 95 and the spot rates for year 1, year 2, year 3 are Z1, Z2, Z3, Z4, Z5, like that. So we do this. The coupon is 10. Now these spot rates, there is a problem with this. This won't discount to 95. You know why? Because these are the spot rates with respect to a government bond. So zero coupon 1-year government bond is having a spot rate of Z1. Zero coupon 2-year government bond is having a coupon rate of Z2. Zero coupon 3-year government bond is having a spot rate of Z3, like that. This means the yield to maturity of a zero coupon 3-year bond is Z3. Obviously the government bond is much more risk free than this corporate bond. So this number is much less. Z1, Z2, Z3, Z4, Z5 has to be generally much less than that of the number required to discount the bond, the corporate bond, to 95. So we need to add some value to this. Now if there is a constant value, a single value which we can add to all of these values to get to that market value, that value will be called the Z spread. this value is called the Z spread. Now let's say this bond also has an option. It can be a call option or a put option. If you take out the value of the option from the Z spread, we get another spread. That spread is called the option adjusted spread. So option adjusted spread or OAS is equal to Z spread minus the option value.